and I hope you've all enjoyed your lunch. Once again, my name is Stephanie Gadbois, and for those of you whom I haven't met, I'm the Executive Director of the Economic Club of Canada. As we gather, we are reminded and we respectfully acknowledge that we are on the traditional territory and home of Indigenous people. The Wendat, the Anishinaabe, the Haudenosaunee, the Chippewas, and the Mississaugas of the Credit First Nation, steeped in a very rich history dating back many generations. The purpose of our acknowledgement today is to show our gratitude and our respect for their contributions and to recognize the role of treaty making in what is now Toronto. For those of you who aren't familiar with the Economic Club of Canada, we are this country's national podium of record and the only nonpartisan national public policy platform in Canada. An organization deeply rooted in Canada with an extensive reach both domestically and internationally, and through forums such as this one today, bringing together some of the most influential people from both the private and the public sectors. We are thrilled to welcome Senior Deputy Governor Carolyn Rogers today to our podium for what is going to be a very relevant and timely conversation. But before we hear from Carolyn, we know that events like this one would not be possible without the generous support of our sponsors. So please help me thank the Canadian Bankers Association for their generous support today. Now please help me welcome Carolyn Rogers, Senior Deputy Governor of the Bank of Canada, for her podium address.
Thanks, Stephanie. Welcome, everyone. I'm glad to see so many people in the room on the morning. Did you know that the Leafs won last night? I don't know if anybody was watching TV, but yeah. So it was about 6 or 8 weeks ago we started working on this speech, and it occurred to me that this was going to be the morning after the U.S. election, and I sort of thought, well, there's going to be a couple of challenges with that. One is there'll be a bunch of tired people in the room who stayed up all night glued to CNN, or including me. And the other one was how to find something that people would be interested in listening to on the morning after the U.S. election. So we, of course, picked housing. We can always talk about housing in Canada, right? So I'm actually not going to talk about housing per se, but I'm going to talk about housing finance. And in fact, back in 2019, I spoke to the Economic Club on the topic of mortgages in my previous job as a bank regulator. And now I'm back 5 years later to talk about mortgages again, this time from the perspective of a central banker. A lot's happened in the past 5 years, to put it mildly. We've seen a global pandemic, the sharpest economic downturn in a century, followed by the fastest recovery on record, and of course a big spike in inflation. Lately, it's been good to see inflation back to our 2% target. Monetary policy worked, not painlessly, but it did get inflation under control without creating the sharp economic downturn that many feared. Interest rates have started to come down, and we have the prospect of further normalization ahead. And yet I know for many Canadians, things don't feel like they're back to normal. While inflation's returned to target, the cost of many necessities is higher than it was before the pandemic. Wages have picked up, but for many, incomes haven't kept pace with prices. And of course, housing remains a big affordability challenge. This is true for people looking to buy a home, and it's also true for renters. For those who have a mortgage, the big worry has, of course, been the interest rate they'll have to pay when they renew. There's been a lot of focus on what's been described as the mortgage renewal wall. More than 4 million mortgages, or about 60% of outstanding mortgages in Canada, will renew in the next 2 years. And a big portion of these haven't renewed since rates started to go up in 2022. And even with the recent declines in interest rates, most of these borrowers will likely face a payment that's significantly higher than what they have now. So at the bank, we've done a lot of work to look at the risks around this rollover of mortgages from a couple of different perspectives. Higher payments could cause households to pull back on their spending, slowing the economy more than we expect. They could also lead to financial stress for borrowers, losses for lenders, and mortgage insurers. And since many mortgages are securitized or bundled together and sold to investors, widespread losses in the mortgage market could also have implications for market liquidity and for broader financial stability. And further, since mortgage insurance in Canada is backed by the federal government, large losses could have fiscal implications. So that's a lot of doom and gloom. So let me be clear, these are the risks. This is not our forecast. Selon nos prévisions, les ménages vont adapter leurs habitudes d'épargne et de consommation à cause de leurs paiements plus élevés. Avec les baisses de taux, cette charge va diminuer et la consommation va augmenter peu à peu. From a monetary policy perspective, our forecast includes the expectation that households will continue to adjust their saving and spending patterns to absorb the impact of higher mortgage payments. And as interest rates come down, that impact will fade and consumption will gradually pick up. From a financial stability perspective, Canadians have a long history of paying their mortgages. Even through the global financial crisis, Canada never saw a mortgage arrears rate above 0.5%. And more recently, our mortgage market has fared well through a period of economic turbulence and a sharp rise in interest rates. Arrears rates have risen, but they remain near historically low levels. But given our recent experience, it's a good time to reflect. Even if the economy is getting back to something approaching normal, we're still expecting a future with more economic volatility and generally higher interest rates than those we've seen in the last couple of decades. Another reason it's a good time to reflect is that mortgage finance rules are one of the levers that policymakers sometimes use to deal with housing affordability. House prices are primarily a function of the balance between supply and demand, but since most of us have to borrow to buy a house, prices are also affected by the cost and the availability of housing credit. The cost and availability of housing credit is, of course, influenced by central bank policy rates, but it's also influenced by government policy and regulation. And that's what I'm going to talk about today. I'm going to start with a few key concepts to make sure we're all on the same page. Then I'll offer a brief history lesson covering some of the important policy changes that have shaped Canada's mortgage market. And finally, I'll draw out a few comparisons of mortgage finance in jurisdictions that do things differently than we do. The objective of all of this is to see where there might be opportunities for change. Homeownership is widely considered to be good for society. So governments in most countries like to incent it by making sure that housing credit is both available and affordable. At the same time, mortgages are the largest debt most people will take on in their lifetime. So governments also like to put laws in place to protect consumers and to make sure they understand the risks that go along with mortgages. And bank regulators pay close attention to mortgages because they often represent a big portion of the assets in the banking sector. In Canada, for example, residential mortgages make up about half the banking system assets. So keeping mortgages safe keeps our banks safe, and a safe banking sector is a precondition for a stable economy. The policy objectives of governments and regulators shift over time in response to changing conditions. And as policies shift, so do the balance and the distribution of the risks. To understand this, it's helpful to keep in mind some basics of how mortgages work and who the different stakeholders are. Everyone knows a mortgage is simply a contract between a borrower and a lender that sets out all the basic conditions, interest rate, amortization schedule, payment schedule, all of that. Once a mortgage is originated, the lender sometimes retains it as an asset or an investment. Other times, they turn it into a security and they sell it to an investor. If the lender doesn't sell the mortgage, they have to fund it. To reduce interest rate risk, they're going to want to fund it with a deposit that's about the same size and duration as the term of the mortgage. Lenders sell mortgages so they have a variety of funding sources and so they don't find themselves constrained by the deposits they hold. So the investors play a really important role in the mortgage market because they give lenders access to big pools of capital, and that lets them fund more mortgages. Whatever your policy objective is, when you set out to make changes to the mortgage market, you need to keep these three groups in mind: borrowers, lenders, investors, because you need all three to have a healthy market. The challenge, of course, is that how you view a change will depend a lot on whether you're a borrower, a lender, or an investor. And sometimes attempts to improve conditions for one can negatively impact the other. Borrowers want affordability, investors want a good risk-adjusted rate of return. Features that reduce risk or flexibility for the borrower can increase risk and flexibility for the lender and investor, and vice versa. The bottom line is that the mortgage market is a careful balance between a variety of policy objectives and a range of stakeholders. To illustrate how this balance has evolved over time in Canada, I'm going to take a couple minutes to walk you through a short history of changes in our mortgage market. Government involvement in Canada's housing finance market can be traced all the way back to Confederation. Very few Canadians had a mortgage back then, and those that did needed a 50% down payment, and their options were generally limited to 5-year loans. Insurance and trust companies were the primary lenders, and the government's role was really one limited to setting out the general rules for lending. One example of this is the Interest Act, a law that dates all the way back to the 1880s, and it's still on the books today and continues to shape the mortgage market we know. I'll come back to this point a little bit later. Starting in the 1930s, the federal government began to move more into the mortgage market. The motivation then was to boost the economy, so policies were targeted at housing construction. And after the Second World War, there was a shortage of homes for returning veterans, so the government created an organization called Wartime Housing Limited to provide mortgage funding at favorable interest rates. Wartime Housing Limited would go on to become CMHC, and in 1954, the government passed the National Housing Act, enabling CMHC to insure mortgages against borrower default. Government-backed mortgage insurance has been foundational to our housing finance market in Canada ever since. Over the years, the features of mortgage insurance have varied significantly. Down payments have ranged from 0 to 25%. Maximum amortizations have ranged from 25 years to 40. And in the early days, only new homes were eligible for insurance. Interest rates were capped, and the minimum term was 25 years. In the late 60s, existing homes became eligible, interest rate caps were lifted, and shorter terms were introduced. All of this helped draw the banks into the business of mortgage lending. Another significant change came in 1987 with the introduction of the NHA Mortgage-Backed Securities Program, and that was followed in 2001 by the Canada Mortgage Bond Program. Both of these programs were aimed at making more funding available for mortgage lending by expanding the secondary investment market for mortgages. Investors in both programs benefit from the fact that all the underlying mortgages are insured and that insurance is backed by the federal government. This helps attract a deep pool of investors and makes funding available to lenders at rates close to that the federal government borrows at. By reducing the cost of funding for lenders, these programs contribute to lower mortgage costs for borrowers. The next set of major policy changes in Canada followed the 2009 mortgage meltdown in the US. The government introduced changes then that were aimed at reducing a buildup of risk that had occurred over a period of expanding access to credit and insurance. A price on the cap of houses eligible for mortgage insurance was introduced, along with stricter underwriting requirements like the stress test. These same events led to more regulation for the uninsured mortgage area. So in 2012, OSFI released Guideline B20, setting out tighter expectations for underwriting and risk management at banks. And in 2018, OSFI added a stress test to Guideline B20, similar to the one for insured mortgages. During the pandemic, further changes to the insured mortgage stress test and to B20 were made, aimed at making sure underwriting standards remained strong through a period of major economic upheaval and emergency low interest rates. And finally, most recently, the government adjusted mortgage insurance rules to provide added support for borrowers facing affordability challenges, and OSFI has signaled further review of B20. So that's a quick history of Canada's mortgage market. It's meant to give you a sense of how changes to policy objectives over the years have shifted the distribution and balance of risks and shaped the market we all know today. Now, let's see what we can learn from how other countries deal with similar challenges. The recent focus on the mortgage renewal wall has people talking about the US, where 30-year mortgage terms are common. Imagine having locked in a 30-year mortgage rate in the last couple of years when rates were at rock bottom levels. Sounds pretty good, doesn't it? But if you're a lender or an investor, it may not sound quite so good because the interest rate risk has shifted from the borrower over to you. And we saw a few US banks fail in recent years when they mismanaged that interest rate risk. The 30-year mortgage has been a feature in the United States for a long time, though, so banks have had a lot of time to adapt their risk management, and the vast majority do a very good job. One way US lenders manage their risk is by securitizing most of their mortgage loans. As a result, unlike Canadian banks, US banks don't hold most of the mortgages they write on their balance sheet. This is a feature of the US market that's generally thought to have contributed to the mortgage meltdown in 2009. This is because US lenders didn't retain the mortgages they write on their balance sheet. They didn't have the same level of motivation to maintain good underwriting standards. We all remember the ninja loans: no income, no job, no assets. Government-backed mortgage insurance is also a feature in the US. While it's not required on high-ratio mortgages the way it is here, many lenders make it a condition of approval. Loan amount caps for insurance eligibility exist in the US as well, but they're set according to local market conditions. US borrowers also pay a higher interest rate on their mortgages. Canadian fixed-rate mortgages are generally benchmarked off 5-year government bond yields, whereas the US benchmark is the 10-year Treasury. Prepayment penalties are more restrictive in the US, but so are other flexibilities. US mortgages aren't portable, for example. So if you have that great low mortgage rate, but you get offered a job in another city with a big raise, you may have to give up your mortgage to get that raise. At the other end of the spectrum, in countries like Australia and Norway, most mortgages have a variable interest rate, so that leaves all of the interest rate risk with the borrower. Amortization periods in most countries range between 20 and 40 years, although a few, primarily in Europe, have 50 and 60-year mortgages, and some even have 100-year mortgages that are designed to be intergenerational. Interest-only mortgages are relatively common, especially in countries where interest is tax deductible, like Denmark, Norway, and the Netherlands. And finally, flexibility options have become increasingly common in most countries in recent years. Here I'm referring to things like skipping or adding a payment, or features like the home equity line of credit that let borrowers draw against their equity on demand. The exception is the US, where mortgage flexibility was significantly curtailed in the Dodd-Frank Act that came into force after the global financial crisis. So, what lessons can we learn from this trip through history and around the world of mortgages? Let me suggest a few. One is that Canada's mortgage rules have changed over the years for all kinds of reasons, from encouraging housing construction and homeownership, to deepening the pool of investors, to curtailing risk and making the financial system more stable. Many different motivations have led to the market we know today. And policy changes have had important implications for the distribution of risk. Today, about 1 in 4 mortgages is insured at origination, and about $590 billion, or about a quarter of Canada's $2.4 trillion in outstanding mortgage debt, is backed by the federal government. So it's not hard to see why a sound, well-functioning housing finance market is critical to our economy. Another lesson is that policy changes introduce trade-offs. There is no free lunch. Steps to reduce the short-term cost of mortgages for borrowers can increase the long-term costs. A quick calculation using current interest rates and the average mortgage size in Canada will show you that a borrower who stretches their amortization from 25 to 30 years will reduce their payment by $200 a month. But they will also pay an additional $50,000 in interest cost over the life of their loan. And while longer amortizations and smaller down payments will increase returns for lenders, they'll also increase risk for both the lender and the borrower because they reduce a buffer that can be used if a borrower runs into stress. Regulators will adjust to this stress by expecting more capital, and investors may adjust by expecting higher returns. This increases the cost for lenders, and that cost often gets passed on to the borrower in the form of higher interest rates. Now, let me come all the way back to the mortgage renewal wall that I started with at the beginning of my speech, because it offers a great example of how the mortgage market is shaped by policy choices. In Canada, a typical mortgage is amortized over 25 years with 5-year terms. This means the borrower will confront interest rate risk 4 times over the life of the loan each time they renew. And in between, the lender or the investor holds that interest rate risk. The prevalence of the 5-year mortgage is no accident. It's due in large part to the Interest Act that I mentioned earlier, the one that dates all the way back to the 1880s. It states that a borrower that takes out a mortgage with a term of more than 5 years has the right to repay the loan in full after 5 years, subject to a maximum penalty of 3 months' interest. However, for the first 5 years of a mortgage, there's no limit to the penalty. So most lenders charge what is called an interest rate differential penalty. Every lender calculates this slightly differently, but generally the borrower ends up paying an amount close to the interest that the lender expected to collect over the entire term of the mortgage. So you can see why lenders prefer to keep mortgages under 5-year terms. They're not precluded from offering longer terms, and indeed some do. But since they hold more interest rate risk, they generally charge a higher interest rate. And so far, that seems to have limited the uptake by borrowers in Canada. In April 2021, for example, 10-year mortgages were available in Canada at an interest rate of 3.14%. At the same time, 5-year mortgages were available at 2.29%. That month, about 80,000 borrowers opted for the 5-year rate, and 400 chose the 10-year rate. Now, since then, of course, Canadians have lived through a period of rapid increase in interest rates. So there's every reason to believe preferences will have changed. But to make longer-term mortgages more available to Canadians, it's likely we'll need some policy changes. So I want to conclude by making 3 points. The first is that our mortgage market has, on balance, served us well across 2 important dimensions: financial stability and access to affordable credit for homeownership. Canada has one of the highest rates of homeownership and lowest levels of mortgage default among advanced economies. The impact of higher interest rates has been challenging for borrowers recently, and it will be challenging for many renewing their mortgage in the next couple of years. But policies that discourage too much leverage and encourage strong, dynamic underwriting like the stress test have proven effective when you look at the experience of the last couple of years. My second point is that when it comes to the mortgage market, there is no such thing as a simple change. The distribution of risks across the different players has many effects, including on the cost and availability of credit and the options and flexibility available to borrowers. Troisièmement, il faut éviter de trop modifier le marché des prêts en voulant résoudre le problème des logements abordables. And third, we need to resist the temptation to try to solve the housing affordability challenge by tinkering too much with the mortgage market. Housing affordability is a very real challenge to our economy. It's encouraging to see governments at all levels focused on this challenge and being creative with the solutions that they bring forward. Ultimately, though, improved housing affordability requires a better balance between supply and demand, and achieving this balance is going to take some time. In the meantime, leaning too much on measures that reduce the short-term cost of financing could have long-term impacts on the financial health of households, the mortgage market, and our economy. This doesn't mean change is impossible, but it does mean it needs to be approached with care. It's always worth asking if there's room to improve, and the world offers us many examples to learn from. It's a question of finding the right balance. Thank you. You want me over there now, right? Okay.
Okay, so we're now going to,
That's going to make it a bit hard to hear.
just a pinch. So not to worry, we're going to get the tech guys to come and fix that pack quickly. We're going to pivot into our fireside discussion, moderated by none other than Patty Levitt-Reid. Please give her a warm round of applause.
While we wait for a mic, I'm just going to say I don't really care about the mortgage market. No, I mean, I do. But I'm going to pivot, if that's okay, because I was one of the people watching TV last night. Yeah, and it wasn't hockey. So can we start? I think,
We can.
you know, I have to be honest.
I'll do my best to project, but,
There we go.
Okay, there we go.
I have to be honest. I said, is there just one thing you want me to stay away from? And they said, politics. And I said, okay, so let's talk politics.
Yeah.
I mean,
Central bankers are allergic to politics.
I know, but no one expected a definitive response, I think, as
Yeah.
quickly as we saw.
Yes.
So what can you share with us?
Well,
I
mean,
will get back to the real estate market, by the way, and housing. Yeah.
I think the Bank of Canada is doing what everybody's doing this morning, is sort of absorbing what we're seeing and the decision, and starting to think ahead to what it means. I mean, in some sense, we were discussing this over lunch. In some sense, a big piece of uncertainty has been taken away, right? So we now know what we're dealing with, and we have another couple months for a campaign to be translated into actual governing and policy. That's where it gets tricky. So we'll wait to see. I mean, we Canada and the U.S. have the largest bilateral trading relationship in the world. Right. So we are their second biggest trading partner. They're our first biggest trading partners. So I think there's plenty of people on both sides of the border that know how important that relationship is. And, I think we'll remain optimistic that as things move from campaign to governing, we'll see we'll see things settle down and work out.
While we talk about trade, one of the things I did notice is that there are going to be policy changes to taxes, to trade, to immigration in the U.S. That could lead to U.S. economic growth, which could lead to inflation, which could lead to, and I'm making a whole bunch of hypotheses here, but which could lead to higher rates in the U.S. Yeah. And I'm wondering if you can comment on the divergence between rates in Canada and rates in the U.S., and then we'll talk about the knock-on effect on the currency.
Yeah, well, I mean, the first and most important thing to say is we set our policy rate for the Canadian economy, and there is some clear differences between their economy and our economy right now. So we have always and will continue to set our monetary policy for the Canadian economy. I mean, we have a floating exchange rate as part of our monetary policy framework. The Canadian dollars priced in foreign exchange markets, that's a feature that's intended part of our monetary policy framework. It's what allows us to set monetary policy for the Canadian economy. It is a buffer to price changes. There's been a bit of worry recently about divergence, but there's a limit to that divergence. I don't think we're anywhere near that limit now. Over the years, we have seen rates between Canada and the U.S. diverge quite a bit more than they are now. So we'll see.
So when I look at economic data, it's probably very different than the economic data you look at. Between now and the December 11th sort of next rate announcement,
Yep.
and obviously I'm not going to ask you unless you wanted to share, but no. I know we have a job report Friday, we have another job report, growth, inflation. These are key points, but can I ask, what other data points does the Bank of Canada look at?
I mean, you named the key ones.
So we're
we
kind
get
of like
national
the same?
accounts. Well, yeah, you're on to us. You're on
Yeah,
to
okay.
us. Yeah, I mean, we're looking at jobs data. I mean, obviously, we look at inflation. We've talked a lot over the last while about underlying inflation. So there's the headline number. We do expect a little bit of bumpiness inflation. We've seen inflation come actually down below 2%. We expect it to come back up as some base year effects come out. So we look at that. We look at job reports. We'll get national accounts. There's a lot of data, and then of course we're looking at what's going on in the world around us.
Right. What do you look at?
Well, I'm pretty sure everyone at the bank was up late last night watching
Okay,
TV.
fair enough. Okay, fair enough. Yeah. Okay, so let's then shift a little bit back to the housing market.
Yeah.
Immigration policy in Canada, how much does that come into play here? Not whether you agree or disagree, but...
Well, I mean, we've had big swings in our population in Canada recently, so it has sort of played it's been a bit more front and center in our forecast than it would normally be, just because it's kind of moving up and down. Obviously, more people in the economy means more consumers, more workers, more economic activity. So, it has a pretty direct effect on growth. On inflation, it has a bit more of a two-sided effect. Certainly, when inflation was early in the climate inflation, one of the things we saw was it was extremely tight labor market. There was a lot of demand for immigration to try and fill some of those vacant jobs and stuff. So in that sense, I think, the immigration was sort of helping bring workers into the economy and taking a little bit of pressure off. More recently, as vacancies have come down, the economy's cooled off a bit. We don't need that same demand for workers, so policy is adapting to that, right? So, I mean, we'll see. On the other side, we have seen increased immigration is adding a bit of pressure on the housing market. So it's a bit more two-sided.
Okay.
Yeah.
When we talk productivity and increase, we've often talked about how Canada has waned. It's fallen short of many of its counterparts, particularly the U.S. Why?
Yeah, well, we wish we knew, right? I mean, I would just say one thing. In fact, actually, the U.S. is really more the outlier. The decline in productivity in Canada is not unique to Canada. It's happened in other countries as well. The sort of the puzzling one is more this really strong pickup in the U.S. What can we attribute that to? I mean, one really clear thing is investment. Business investment. I mean, U.S. companies invest, I think, twice as much per worker relative to Canadian companies. So a more competitive business environment that drives sort of firm turnover a bit more, that firm creation. The types of things that U.S. companies invest in too, they invest heavily in technology, telecommunications, IP, more recently AI. So U.S. companies tend to be kind of out on the front foot on these sort of developments, right? They don't sort of wait to see if things. Canada, we're a bit more cautious. We kind of wait to see, is it going to work? And when I see it working somewhere else, then maybe I'll make an investment in it. That's sort of not the investment culture in the U.S. And I think that's showing up in really stellar productivity growth.
Mm-hmm. When I think and see the number of reports out there There's going to be a transfer of wealth in Canada to the tune of $1 trillion between now and the end of 2025. And that has to have some sort of impact, I believe, on the housing market, and maybe even a bifurcation here in Canada of those who have and maybe those who have not, depending on the wealth that maybe a parent in a household was able to amass. So what's my question? What kind of, do you see any sort
You're
of...
well outside of my lane now. And
Okay,
you're
I was just thinking about it on the way
Yeah.
here. Well, I do think that because affordability you made reference to, and affordability is a challenge.
Yeah.
We have 4 children all in their, I'm going to lie, 30s. No, just about 40. And the affordability was a real issue.
I mean, what I would say is the uneven effects of what we've gone through over the last couple of years. Inflation is the thing that we look at most closely, but the uneven effects of what's happened in our economy over the last couple of years is something that we worry about. Yeah. Particularly inflation. Inflation hits people who are on a tight budget by far harder than it does the people who have a lot of discretionary income. It hits people who don't have assets. Right. So, yeah, people on fixed incomes, lower income people, because and what's been particularly challenging, I think, is it's necessities, things that you can't avoid, that have really seen some of the biggest increase in costs. So, groceries, rent, no matter how careful you are a shopper, you can't avoid some of those costs. So we definitely think about that, the disproportionate effects of inflation. Among the many things that were motivating us to get us back to price stability, that was definitely at the top of the list.
When you talk about inflation, can I just ask, I'm just wondering, is 2% a reasonable inflation target?
Yeah, so lots of people asking that now. There's a bunch of things going on in the world, supply chain issues, geopolitical, demographics, things that might suggest we should be rethinking the 2% target. What I would say is, there is a ton of research on this, and there's a ton of opinions on it. The thing that I like, the reference point that I like the best is 2% inflation. There's research and history that show us that 2% is a rate of inflation that people don't notice. They just get on with life. They make their decisions without thinking about inflation. They don't have to worry about it. It does, in fact, when you're making a decision to buy a home or invest as a business or plan a big purchase or whatever, you got a lot of things to think about. It'd be nice if inflation wasn't one of them. So price stability is a way to sort of take that out of the equation. And there's research and history that tell us that number is 2%. If it gets much higher than 2%, it does start to factor in. People start to worry about it. Now, we do have a range that gives us room. We don't have to be at 2% every month after month. We have a little bit of range to sort of absorb a bit of shock and stuff like that. But that's why we like to. But what I would say is 2% is part of what we call our monetary policy framework, which is an agreement between the Bank of Canada and government that gets renewed every 5 years. And that question, do we have the right target, among other questions, get asked as part of renewing that agreement. And the next renewal of our monetary policy framework will happen in 2026. And so we are gearing up to have a year where we will be asking these kinds of questions. We will be doing a lot of public outreach, a lot of research. So it's a good time to ask the question.
So for you to describe the good that's going on in Canada, what would you highlight?
Well, if you come back to productivity, there's things in Canada that if you think as an economist about what are the sort of inputs to having good productivity, we have some of those. And so this is one of the reasons I think it's a bit of a puzzle. So we have a long track record of being good at integrating people into our economy. When we bring people in from other countries, when we have immigration, we have been good at integrating them into our communities, into our society, and into our job market. We need to keep that as a strength. We have really great university. I mean, we just won the Nobel Prize in artificial intelligence. So we have a lot of smart people in this country doing leading edge research on really important, potentially productivity boosting technologies. The problem is we don't tend to be the country that commercializes those and starts to use those types of technologies to improve business and investment and stuff. So we have a lot of really good foundations there. We have rule of law. We are a stable democracy. We have a lot of things that in other countries you can't take for granted as much anymore. So I think there's lots of strengths.
There were certainly a lot of comments on proud to be Canadian this morning.
Yes.
There certainly came through feeds.
Yeah.
We often talk about the wild cards. I'm not going to go there because I think we all sort of know what the wild cards are out there. What is the thought you would like to leave this group with?
I mean, probably the one that we just talked about, right? There
you want to go back to housing?
No, we're not talking about housing. I mean, the point in the speech was just that you always have to take the long-term view, I think would be how I would summarize it. And stability is something, financial stability, policy stability, certainty, those things happen as a result of a bunch of small decisions over time, and it's an important thing not to take for granted.
Excellent.
Yeah.
All right. I'd like to thank you for going with the flow.
Thank you. Okay.
And we didn't really talk politics.
No, we didn't.
Well,
no, we didn't.
a little.
No,
Thank
no,
you.
no.
Over to you.
A big round of applause.